When you walk into Mark's house, you immediately sense something specific. It is not grand. It is a 4-bedroom colonial situated in a decent neighborhood. But nothing about it makes your jaw drop. The kitchen still has the same countertops from the year 2019. His vehicle is a 4-year-old sedan he purchased for $32,500 in cash, and he plans to drive it until a major component fails. He works perhaps 44 hours weekly, takes 3 genuine vacations annually, and when the market dropped 29% in 2022, he went for a jog, returned home, and did not check his brokerage account for 2 weeks. Mark is 46 years old. His net worth sits at $1.92 million. Now, step inside Steve's house. Steve lives just 3 miles away. He leases a $74,000 luxury sedan, having renegotiated last year into something more practical. His kitchen underwent a renovation in 2022, costing $48,500. He holds a brokerage account containing 6 stocks he genuinely believes in. He owns a home valued at $865,000 that he cannot sell without destroying his 3.2% mortgage rate, and a financial life that appears extremely successful externally while feeling genuinely precarious internally. Steve checks his portfolio whenever the markets move. He works 58 hours a week. He earns more than Mark in most years. Steve is also 46. His net worth is $325,000. They share the same city, the same starting income, and the same decade. One of them constructed wealth, while the other funded the appearance of it. This video is not about how to begin building wealth. It is about every specific trap waiting for you once you already possess some capital. The ones that remain completely invisible when you have nothing and become brutally expensive the moment you do. I am Pam, and I spend far too much time studying why individuals who should be financially free end up financially stuck. If that is something you wish to avoid, ensure you subscribe because we are going through every single one. Trap 1. Lifestyle creep, and why it worsens the more you earn. Let's begin with the one that is already happening to you, and you probably have not fully clocked it yet. Goldman Sachs surveyed over 5,000 Americans for their 2025 retirement report, and buried within that data is a figure I keep revisiting. Among households earning between $260,000 and $510,000 per year, roughly 44% report living paycheck to paycheck. For those making over $510,000, it is still nearly 39%. Nearly half of the people making over $500,000 annually have almost nothing remaining at the end of the month. Here is what makes this genuinely strange. The situation is actually worse at the top than in the middle. Households earning $210,000 to $310,000 only reported a 15% paycheck-to-paycheck rate. Something does not just grow on the way up, it accelerates. And that something is your standard of living, quietly consuming every dollar of every raise before you even notice it is gone. There is a concept called the Diderot effect, named after a French philosopher who received a beautiful scarlet dressing gown as a gift and ended up in debt, replacing his entire room's furniture to harmonize with it. The desk looked shabby next to the gown, then the chair looked wrong next to the desk, then the rug, then the art. He called it the dangerous new companion. Economists call it a consumption cascade. Your brain calls it, I deserve this. And it does not cease until the money does. You upgrade the apartment. Now the furniture looks wrong. You fix the furniture. Now the car is embarrassing. You fix the car. Now the neighborhood does not match. Each purchase is individually justifiable. Collectively, they consume your entire net worth growth every single year without ever feeling like overspending. The fix is uncomfortable but simple. When your income increases, your savings rate increases first, before the lifestyle catches any of it. If you receive a $16,000 raise, $8,500 goes into investments before you feel a single dollar. That one rule applied consistently is probably worth $420,000 over a career. And if you do not apply it, the Goldman Sachs data suggests you will find ways to spend $510,000 a year and still feel broke doing it. Trap 2. Overconcentration in a single asset. This one tends to strike people who have actually been successful. which is what makes it more dangerous, not less. Tell me if this sounds familiar. You purchased something, a stock, a piece of real estate, your company's equity, and it increased significantly in value. You told a friend about it at some point, perhaps casually, perhaps less casually, and now you're in a relationship with this asset. It is part of how you perceive yourself financially. Selling feels like a betrayal, or like admitting you do not actually believe in it, so you hold, and the position keeps growing as a percentage of everything you own. You are now technically gambling. You just do not feel like you are because it has worked thus far. Consider a dominant technology company during the dot-com boom, a profitable business with real earnings. It peaked at around $78 a share. Within 2 weeks of that peak, it dropped 21%. Shortly after, it was down 37%. After a revenue warning, it fell 41% in a single trading session. Eventually, it was sitting at $13. That is an 83% decline. And here's the part that still gets me. It took 26 years just to break even. Someone who held only that stock at the peak did not just underperform the market. They waited over 2 decades to recover. But that specific company isn't the sole cautionary tale. It is just the one you can show on a chart. J.P. Morgan analyzed every Russell 3000 stock from 1982 to 2015, roughly 12,500 companies. They found that 39% suffered a permanent decline of 72% or more from their peak. In tech specifically, nearly 2/3 experienced catastrophic loss. The index returns look good because a small handful of extreme winners compensated for everyone else. You do not get to know which bucket your stock is in before you decide how much to hold. The rule most portfolio managers agree on is straightforward. No single position above 12% of your portfolio. Most say 6% is safer. The attachment is the trap, not the asset itself. Trap 3. Tax inefficiency, the slow bleed nobody notices. You had a great year. Your portfolio is up. You sold a position that doubled, and you are feeling good. Then March arrives, you open your tax software, and you are staring at a number that does not make sense. You made $62,000 on that trade. You owe $25,300 in taxes, not because you did anything wrong, not because of some audit, because you sold the position in month 11 instead of month 13. You owe nearly $10,500 in unnecessary taxes on a single $52,000 gain just because you were impatient. This is what tax inefficiency looks like. Not fraud, not complexity, just timing mistakes and placement errors nobody sat you down and explained. Morningstar found the average equity mutual fund lost 1.52% of its returns annually to taxes. Compounded over 20 years, that is roughly a 36% reduction in ending wealth. On a $520,000 portfolio, you are looking at $187,200 gone. Not to bad investments, not to a crash. To poor tax management, the most common mistakes, holding high dividend stocks and REITs in a taxable brokerage instead of an IRA. Every dividend becomes a taxable event, whether you wanted to sell anything or not. Not harvesting losses is another. When a position is down, selling it locks in a loss you can use to offset gains elsewhere without changing your market exposure. And selling before holding a full year. If short-term gains are taxed up to 43.4%, including the net investment income tax, while long-term gains max out at 23.8%, that 19.6-point spread costs you $9,800 on a $50,000 gain. Because you could not wait 2 more months. Taxes are almost certainly your single largest annual expense. Bigger than your mortgage, bigger than anything else on your statement. The wealthy do not always earn more. They just make sure the IRS takes as little of it as legally possible. Trap 4. Overconfidence after early success. Here is a trap that specifically targets smart people who have done things right, which makes it very effective. You had 2 good years. The stocks you picked went up, the real estate deal worked, the business grew faster than you modeled, and your brain very naturally files this under, I am good at this. Psychologists call it self-attribution bias. We credit gains to skill and losses to bad luck. It is not a personality flaw. It is how human cognition is built. But in investing, that wiring is expensive. I have watched this happen to people I know. One great year in a bull market, and they start concentrating positions, moving into options, buying on margin, going from a diversified portfolio to 5 names they believe in. The boring index fund that was quietly compounding becomes a trading account that requires daily attention and produces monthly heartburn. And here's the thing. For a while, it keeps working because markets trend up. Because a rising tide makes everyone feel like they know something. The academic data on this is blunt. Researchers in Brazil tracked nearly 21,000 people who started day trading equity futures. Among those who persisted for more than 300 days, 98% lost money. Not most of them. 98%. Only 19 individuals out of nearly 21,000 earn more than the local minimum wage through trading. The researchers found no evidence of learning. Performance actually worsened the longer people persisted. The market has a very specific sense of humor. A bull market is not feedback. When the entire market is up 26% and your portfolio is up 26%, that tells you almost nothing about your skill. The test is what happens when conditions change, and by the time conditions change, overconfidence has usually already pushed you far out on the risk curve, which is exactly when you can least afford to be there. The counterintuitive protection is boredom. The most effective strategy for most people is aggressively boring. Broad index funds, automatic contributions, minimal intervention. The moment investing starts feeling exciting, that is usually a warning signal, not an invitation. Trap 5. Working too much. Nobody frames this as a financial trap. It absolutely is. There is a point in wealth accumulation where your time becomes worth significantly more than your marginal labor, and most people blow right past that moment without noticing, because working hard is what got them here, and slowing down feels like losing. Run this math. $5.2 million invested at a conservative 5% annual return generates $260,000 a year. That is $712 a day. Weekdays, weekends, national holidays, days you are sick. At that threshold, every additional hour you work needs to justify itself against the diminishing return of more income stacked on top of $712 in passive daily income. Past a certain point, you are not working for financial gain. You are working from habit. Bronnie Ware spent 9 years as a palliative care nurse, sitting with patients in their final 10 weeks. She documented the 5 most common regrets of the dying. Number 2, expressed by virtually every male patient she cared for, was, "I wish I had not worked so hard." Not "I wish I had earned more," not "I wish I had taken bigger swings." "I wish I had not worked so hard." The question worth sitting with is simple. What is your time actually worth now compared to when you started? Because if that number has not changed how you allocate your hours, you are probably leaving the most valuable thing you have on the table. Trap 6. The illiquid millionaire trap. This is a trap that is genuinely new in scale, and it is minting more victims every year. Bloomberg analyzed Federal Reserve data from 2023 and found that households with net worth between $1.1 million and $2.1 million and $2.1 million, 67% of their wealth locked in illiquid assets, primarily home equity and retirement accounts. 2/3 of what they have, they cannot access without a 6-month real estate transaction, an IRS penalty, or waiting until they are 59 and a half. The illiquid millionaire is a specific kind of uncomfortable. Technically wealthy, genuinely constrained, you cannot move fast on an opportunity because everything you own is either locked in a house with a rate you would be insane to abandon. Sitting in the retirement account, you will pay 10% to touch early or committed to a private deal with a 5-year lockup. You are rich in theory. You are illiquid in practice. The practical rule is 3 to 6 months of essential expenses in actual liquid cash, not invested, not in a CD, not almost accessible, liquid. Beyond that, watch the percentage of your total net worth you can access within 30 days without material tax consequences. If that number is below 16 to 21%, the portfolio needs a liquidity audit before it needs anything else. Being technically wealthy while practically cash-constrained is not a success story. It is just a nicer-looking version of the same trap. Trap 7. Neglecting insurance as your assets grow. This one is not exciting to talk about, which is exactly why it causes the damage it does. As your net worth grows, you become a more valuable target in litigation. This is not paranoia, it is math. A recent private risk services survey found that 22% of high net worth households carry zero umbrella liability insurance. Meanwhile, 14% of personal injury awards now exceed $1 million, and large jury verdicts are becoming more common, not less. One car accident, one guest who slips at a party, one situation where you are in the wrong place with the wrong outcome, and a judgment reaches past your auto and homeowner's limits straight into your investment portfolio. An umbrella policy adds $1 million in liability coverage on top of your existing policies. The annual cost is typically $350 to $650. $5 million in umbrella coverage might cost you $900 to $1,300 annually. Still a rounding error on a meaningful portfolio, and the policy standing between a bad day and a catastrophic one. The full checklist grows with net worth. Umbrella liability, updated homeowner replacement cost, increased auto liability limits, valuable articles riders for jewelry and art, and D&O coverage if you have a business. None of these are complicated. All of them get skipped because they are not exciting, and nobody reminds you to revisit them until something goes wrong. Trap 8. Confusing owning many things with being diversified. You own 6 ETFs. 4 of them are U.S. large-cap equity funds with slightly different names and nearly identical holdings. You have a brokerage account and a 401k and a Roth IRA, all invested in variations of the same thing. You feel diversified. You are not diversified. You are concentrated with extra steps. The deeper problem is correlation. In 2008, pairwise correlations between equity asset classes spiked from roughly 42% to nearly 71%. Everything moved together when it mattered most. Owning small-cap U.S. funds alongside large-cap U.S. funds did not help. International developed markets did not help. Almost everything dropped simultaneously because fear does not care about your allocation percentages. Real diversification means assets that do not respond to the same stressors. David Swenson ran Yale's endowment for 37 years, averaged 13.8% annual returns, and grew the portfolio from $1.4 billion to $44 billion by putting 61% into genuine alternatives, private equity, real assets, venture capital. His core insight, genuine diversification across uncorrelated assets, is what actually reduces long-term risk, not the number of tickers, the correlation between them. You do not need to replicate an institutional endowment, but owning international exposure, some real assets, and thinking carefully about what actually moves independently. That is the difference between real diversification and its very convincing imitation. Trap 9. Panic selling when the numbers get enormous. Here is the trap that specifically gets worse as you get wealthier, and almost nobody talks about it that way. When your portfolio was $42,000 and it dropped 20%, you lost $8,400 on paper. That hurt. But it was abstract enough that you could breathe through it. When your portfolio is $2.1 million and it drops 20%, you have lost $420,000. And your brain, which evolved in environments where losing that much of anything would be genuinely fatal, has no framework for processing that number calmly. The loss aversion does not scale with your portfolio's ability to recover. It scales with the raw dollar number, which means the wealthier you get, the stronger the pull to do something when markets fall. A recent investor behavior report found that the average equity investor earned 16.2%, while the S&P 500 returned 26.1%. Over 20 years, compounding that behavioral gap turned $105,000 in a buy-and-hold index into over $760,000. The average investor ended up with less than half of that, nearly $380,000 lost. Not to bad companies, not to crashes, not to fees, to human behavior, to buying when things felt good and selling when they did not. During the COVID crash in March 2020, investors pulled $330 billion from funds in a single month. The market bottomed on March 23rd. It rallied 72% over the next 12 months. Every dollar that fled at the low missed the entire recovery because the dollar amounts had gotten large enough to override rational thinking entirely. The protection is not willpower, it is structure, automating contributions so there is no decision to make during a downturn, writing your plan down before the crash so you have something to hold on to when clarity evaporates, and not checking the portfolio during volatile periods unless something in your actual life has fundamentally changed. Set this strategy before the fear arrives, because once it does, you are running ancient software in a modern financial system, and the ancient software nearly always loses. Trap 10. No estate plan. This is the trap people defer longest, because thinking about it requires imagining something nobody wants to imagine, and the deferral costs a fortune. Prince died in April 2016 with an estate valued at $160 million, no will, no trust, no estate plan of any kind. What happened next? 7 years of litigation, over 2,700 court filings, $46 million in legal fees, $62 million in federal estate tax, and $25 million in state estate tax. Roughly $90 million, 56% of everything he built, consumed by a problem that a proper estate plan would have largely prevented. 2 of his siblings died during the probate process. A $105,000 estate plan would have saved $90 million. That math is hard to look at. A recent survey found that only 27% of Americans have a will. Even among people with meaningful assets, failure to plan is the overwhelming norm. Irrevocable living trust avoids probate entirely. Updated beneficiary designations on your 401k, IRA, brokerage accounts, and life insurance, each of which overrides whatever your will says, cost nothing to change. These are not complicated moves. People just do not do them because they require sitting with an uncomfortable subject long enough to take action. The Williams Group studied 3,300 wealthy families over 20 years and found 71% lost their fortune by the second generation, 91% by the third. Cornelius Vanderbilt died in 1877 with the equivalent of $3.1 billion in today's money. By 1973, at a family reunion of 125 descendants, not a single one was a millionaire. Building wealth is one skill. Structuring it to survive is an entirely different one. Go back to Mark and Steve for a second. Steve is not a cautionary tale because he failed. He did not fail. He worked hard, earned good money, made a lot of right moves. He just did not realize the traps changed on him somewhere around the time his net worth crossed 6 figures. The risks shifted, got more sophisticated, more expensive, and nobody told him that building wealth and protecting it are 2 completely different games with 2 different skill sets. Mark did not get to $1.92 million because he was smarter or luckier. He got there because he understood, maybe intuitively, that the enemies of growing wealth are not the obvious ones. Not market crashes, not job loss, not bad luck. They're slow creep, emotional decisions at big dollar amounts, inaction on the boring stuff that never feels urgent until it is catastrophic. Somewhere in this list, you recognize something. Maybe it was the lifestyle creep. Maybe it was the concentrated position you are a little too attached to. Maybe it was the will you have been meaning to update for 3 years. That recognition is worth more than everything else in this video. Go fix that one thing, just one. Don't watch another 10 videos first. Go fix it today. If this helped you see something you had not seen before, hit subscribe, because this is what we do here. I am Pam, and I will see you in the next one.